Okay, so in the SFM Dawn series, we are now starting with bond valuation. Now, bond valuation has always been a quite tricky topic in CA final. It is not like Forex. We know that the CA final SFM paper is crowded with Forex all the time. But bond valuation, sometimes it shows up, sometimes it doesn't show up, okay, and sometimes it shows up too much. When I had done the SFM English classes, that time money market was not explicitly included in the SFM new syllabus. But later, the CA Institute has included money market. Although we did some money market as a part of our bond chapter because treasury bills and all that were there. But still money market is now a very important component, and anybody appearing for the SFM exam should not be not aware of the same. He or she should know how money market sums will come. You know what is money market? It is the market for short-term funds. So governments raise money through treasury bills, banks raise money through certificate of deposit, corporations raise money through commercial paper. The link between all the three, treasury bills, CDs and CPs, is that they are all short-term and they are all pure discount security. That means they are issued at a discount, redeemed at par. Issued at a discount, redeemed at par. Okay, so it's like we suppose have a 91-day treasury bill which is issued for 98.75. 91-day treasury bill, maturity 91 day, issued at 98.75. So if you buy the treasury bill, you will pay 98.75 today and you will get 100 on maturity. Okay, that is after 91 days. So what is it that you are earning? 100 minus 98.75. Okay, and you are earning this by investing 98.75. So if somebody wants you to calculate the money market yield, it is calculated as, I'm just showing it to you on the board. F minus P divided by P into 100 into 360 by N. Some people use 365, some people use 360. Okay, money market yield is calculated with the help of this. I am just writing 365 over here because both answers are acceptable. Okay, 360 or 365. You see, I have divided by P, that is 98.75. This is how you calculate the yield on commercial paper, you calculate the yield on certificate of deposit, you calculate the yield on treasury bill. Of course, we know that this is not the effective yield, but in the money market, they don't calculate effective. Even if they say effective, they seem to calculate it with the help of 365. Okay, so they never do the power thing in the money market. Power thing is not done, like 1 plus R power N, it's not done. It's always in a simple interest mode. Okay, even if they use the word effective, in the money market, effective means please use 365 and remember that P is the price at which we purchased. So you should know this, okay, clearly. Now, if it's a case of commercial paper, in that case, they will give the sum from the issuer's point of view. They will give the sum from the issuer's point of view. What do I mean? I mean to say, if a company issues a commercial paper, then what I showed to you on the board, is the effective interest cost for the company. You will take 365 effective interest cost for the company. And then the company also has to incur three charges: the stamp duty, rating charges and brokerage. Rating charges per annum, but the stamp duty and brokerage are periodic, so they have to be converted into per annum and added to the effective interest to find out the effective annualized cost of the commercial paper issue. I'll show it to you in some time, don't worry. Okay, so that's an important sum on commercial paper. We will do one sum on the same, okay, in money market. I would also like to tell you that this formula can also be written in this form. For example, price is always the present value of the face value. So price is equal to F divided by 1 plus its number of days by 365 into I. Say the I is given to us. Like this is the I. So this I is given to us. So I can use this format of the formula, that price is the present value of the face value, F divided by 1 plus N by 365 into I. So I think you should know both the formats. Use this format when the price is given and you have to find out the effective interest. And use this format if the effective interest is given and you have to find out the price. This is very simple stuff. Usually, you know that in finance, when we do present value, we do it this way. P is equal to F divided by 1 plus I power N. N means N by 365, whatever. But in money market, we don't use these formulas. It's all simple interest going on. So this is not used in the money market. Another chapter where this power and tower are not used is the mutual fund chapter. Okay. So you got to remember this. So two formats. There's no question of confusion. So this formula when to use. If you are asked to find out the effective interest and price is given, use the above formula, the red one. And if the effective interest is given and you are asked to find out the price, use this one. Sir, can I use only one formula, this one for both? Yes, but you are wasting time. Correct? Okay. Let's come to the first question then. Just 1 second. Yes. So this is the PDF sheet that we have for bond section, and there are 12 questions I have taken. I have not tried to do it like Forex, say 40 questions, because obviously the importance of a topic depends upon how important it is for the exam, and that way we have to adjust. So I am going to that money market sum. Give me just 1 minute. Okay, just 1 minute. So we have this, money market. Question number 9. In our PDF, question number 9 is on money market. Z company issued commercial paper worth 10 crores as per the following details. So the company is raising funds via commercial paper, 10 crores, face value. Date of the issue 16th Jan 19. Date of maturity 17th April 19. 16th Jan to 17th April. That is 91 days. Interest rate is 12.04%. So they've given us the interest rate. That means we have to find out the price via the second formula. What was the net amount received by the company on the issue of commercial paper? Bracket, charges of intermediary may be ignored. I was talking about the charges, the stamp duty, the brokerage and the rating charges. We'll ignore all of them. Find out what was the issue price. So it's very, very easy sum. Let's do it. We'll apply this formula. I am writing the formula again. Price is equal to the face value divided by 1 plus number of days by 365 into the effective interest. Effective here does not mean per annum compounded annually. It is just used in the colloquial sense. So price is equal to, face value is what? 10 crores divided by 1 plus number of days was 91. And interest rate is 12.04, so 0.1204. You just need to calculate this and you get the answer. Please calculate, take your time. Please calculate. So the answer is coming to 97085,726. So how are you calculating? A student is sitting by my side. He is doing the calculation for me. 97085,726. I'm sure you all must have calculated this. So this is the price. Sir, can be calculated by the first formula? Of course you can. You could have done 12.04 is equal to 10 crores. That is F minus P divided by P into 100 into 365 by 91 and solve for P. So you can do it this way also. But that would be stupidity. I think if you are asked to find out P, better apply the formula for P. If you are asked to find out I and P is given, better apply that formula. So it's common sense. Okay. Coming to CA final, this should be very obvious to you. Now, what I was saying is that suppose in this sum, the question would have been calculate the annualized cost of issuing the commercial paper if stamp duty this much, rating charges this much, brokerage this much. Okay. So in that case, you need the 12.04%. Please understand. So 12.04 is given. If the price was given, you know how to calculate 12.04. So then what you would do is that you will take the effective interest, that is I. You will add the rating charges. These are already per annum. Don't tinkle with them. Add stamp duty. But stamp duty is periodic. So you will have to do whatever stamp duty is given, that into 365 by 91. Okay, then add brokerage or dealer's commission, whatever, into 365 by 91. I am saying 91 because it's a 91-day commercial paper. Don't book me for that. Okay, so rating charge is already per annum, I is per annum, rating charge is per annum, stamp duty is periodic, so convert it into annual. Brokerage is periodic, convert it into annual, and then add, and you get the entire thing. Okay, and you get the entire thing. So this entire thing total is the cost of commercial paper. So only these two types of sums on commercial paper can come. Hope you will be able to handle. Okay, perfect. So this was one sum on money market. Those people who had done the English classes at that time, commercial paper was not in the syllabus. Money market was not. Later it was included, but it's cakewalk stuff. Okay, so commercial paper is okay. The second type of sum that can come on money market is repo. Repurchase obligation, you must have heard it, repo. Okay, now when we say repo, repurchase, that means there was an initial sale. So one bank, say Bank of Baroda, needs funds, short-term funds, say for 10 days from SBI. So Bank of Baroda needs short-term funds from SBI. So Bank of Baroda will sell its government securities to SBI. Bank of Baroda will sell its government security to SBI. So SBI will provide the loan. That's a loan. And after 10 days, Bank of Baroda will have to repay the loan amount together with 10 days interest. When it repays, it repurchases the security. So it's a sale and repurchase. Actually, it's a loan and loan repayment. SBI is very safe over here. Why? Because while giving the loan, it is getting a transfer of the security in its own name. So it's very, very safe. Okay, risk is not there at all. That is what repo is. So as a part of repo, there are two legs. Okay, I'm just showing it to you. There are two legs as a part of repo. First leg. In my example, we have Bank of Baroda, we have SBI. I told you Bank of Baroda will sell GOI to SBI. SBI will loan the amount. Correct? So we need to calculate this. This is the first calculation required. Calculation number 1. What's the loan SBI will give to Bank of Baroda? Now the second leg, I'll come to the first leg, don't worry. Now the second leg is that Bank of Baroda has to return back to SBI the loan plus repo interest. Loan plus repo interest. Okay, and SBI will obviously Bank of Baroda therefore repurchases. Okay, repurchase, hence the name repo. Repurchases, okay, the GOI. So this is the second calculation. Are you seeing? This is the second calculation. Okay, loan amount plus repo interest. Perfect. Now let's come to the first leg. In the first leg, what shall be the loan amount? Loan amount shall be clean price plus accrued interest minus initial margin or haircut. Okay, clean price plus accrued interest minus initial margin or haircut. If you are copying, it's very good. So there is a certain price of the Government of India security, but the Government of India security is a coupon security. We are standing somewhere in between. So accordingly, accrued interest has to be added. You know what accrued interest is. If you don't know, then what do I say? Accrued interest means the date, the coupon since the last coupon date till the date of the repo. Okay, and minus a haircut, an initial margin. Okay, because SBI doesn't want to loan the entire amount. It will deduct some 1%, 2% haircut. So this is the amount that has to be this thing. You will be given a certain, say the repo is for 5 crores. So 5 crores is the face value. You have to find out the clean price will be given to you. You add the accrued interest based on the coupon and the days since the last coupon date to repo, and then initial margin percentage shall be given. This is first leg. I am afraid the first leg you can make it wrong. Everywhere use 360 days. In a repo sum, please use 360 days. In a repo sum, please. Okay. And then the second leg is very easy. Whatever you got in the first leg, that first leg plus the repo interest rate will be given. Logically, I believe over here 365 days should be used, because as per my knowledge, I have seen it everywhere. But they are using 360 days. Institute is using 360 days in a year. Okay, so even if somebody tells me, let's say you taught conceptually wrong, we should use 365 days in the second leg, I can't help. I am concerned with ensuring that you get full marks. Okay, first leg, second leg. Okay, let's look at the question. So we are coming to the question. Bank BK enters into a repo for 9 days with Bank NE in 6% government bond 2022 for an amount of 2 crores. So 2 crore is the face value of the security sold. It's a 9 days repo. Okay, and 6% is the coupon. The other details are first leg 2 crore 6,750. So they've already calculated everything. Yeah, you understanding? 2 crore had a certain clean price. I don't know how much. Then accrued interest was added. Accrued interest, they've written days of accrued interest 240. So 240 days 6% was added to that clean price. And then initial margin 1.25% was deducted. So this 2,000,6,750 is arrived by adding accrued interest to the clean price and deducting the 1.25% initial margin. Please understand. Okay. Second leg also is given. So after this 2,6,750, interest has to be paid, okay, for 9 days, and that entire thing comes to 2,003,1,759. So I've seen the first sum of this type where both the first leg, second leg are given. So it's a sum on back calculation. They're asking us to take 360 days in a year. You are required to calculate the repo rate. Okay, repo rate is like you have taken a loan of 2,6,750, repaid 2,31,759. What is the interest rate? The interest rate is the difference divided by the loan amount 2,006,750 into 360 divided by 9. This is the easiest thing in the world. The loan amount is 2,6,750. The repayment amount is 2,31,759. So what is the interest rate? It is the difference divided by the loan amount 2,6,750 into 100 into 360 divided by 9. I hope you are understanding. I don't have to write and do it, but you never know what happens when we are stressed out. So let me just solve it. I'm finding it very odd to solve. Interest rate, the repo rate, is equal to the repayment amount 2,31,759. 31,759 minus the loan amount 2,6,750 divide by the loan amount. You have to be taught that you have to divide by the loan amount every time it happens, and it's into 100. So this is for 9 days. So annual is into 360 by 9. Yeah, what is the answer? The answer is 5% is the answer. That's the repo rate, 5%. You know, as a part of COVID, Reserve Bank of India went on deducting the repo rate. Otherwise, repo rate used to be higher, 6.5%. Okay, 5% is the repo rate over here. The second question that they're asking is calculate the dirty price. So the loan amount 2,6,750 was the clean price plus accrued interest, dirty price less 1.25%. So this 2,006,750 is 98.75%. It's after deducting the initial margin. Are you getting me? Dirty price into 98.75% is the 2,6,750. So what is the dirty price? So this 2,6,750, okay, 2,006,750 divided by 0.9875. 2,006,750 divided by 0.9875. This is 20260. 1 second. 20260,000. Now, but when they ask for the dirty price, they ask it in terms of per 100 of face value. This is for a face value of 2 crore. So for dirty price per 100 of face value, per 100 of face value is equal to this divided by 2 crore into 100. Yeah, common sense. What does it come to? It's coming to 101.3. Okay, so you have to calculate it as per 100. So 101.3 is the dirty price. Okay, dirty price 101.3. Now, clean price. So clean price is 101.3. The dirty price is clean price plus accrued interest. So we have to remove the accrued interest for 240 days at the rate of 6%. Let's do it. So accrued interest based on 100 is 6% of 100 into 240 by 360. I'm calculating the accrued interest. 6% of 100 into 240 by 360 is 4 rupees. So 4 rupees is included over there. So clean price is the dirty price minus the accrued interest. So 101.3 minus 4 is equal to 97.3 answer, clean price. I'll request you, this was a back calculation sum. You should also do one sum which is given in the chapter security analysis in our SFM MAT new edition. SFM MAT new edition, there is a sum on repo given. Okay, sum on repo given, which is a direct sum. This was a back calculation sum. Please do that sum, because a sum on repo can come in the exam. A sum on repo can come in the exam if you do those two sums. One sum from the SFM study mat security analysis chapter and the other sum this one. Okay, so in that case you are completely fine. There's no risk at all. Okay. Now according to my knowledge, see, in the sum it was given that you have to take 360 days. In the sum it was given take 360 days, but according to my knowledge, in the second leg we should take 365 days. Of course, you can give a note and take 360 days in the entire sum. So knowledge wise, in the second leg we should take 365 days, but for accrued interest and all that we should take 360 days. That's the rule. Okay, so that was money market. Okay, money market is now over. Now, after money market, what do we go into? Let's go into optionally convertible debentures, OCD, optionally convertible debentures. Now this is one of the easiest portions in the syllabus and mechanical, where investor has the option to decide whether to convert a bond into shares or to hold the bond as non-convertible. And therefore the bond has two values. One is the straight debt value or investment value, which is just the present value of the coupon and redemption, and the other is the conversion value, which is the number of shares into share price. Are you getting it? Because if I hold it as bond, what's the value? If I convert it, what's the value? Whichever is higher, that's the floor value, but the bond trades at a higher price because the investor enjoys the option feature. Okay. Anyways, we are not asked questions on the valuation, we asked questions on the features. For example, what is the premium over conversion value? So it's the bond price minus conversion value by conversion value. Premium over investment value, it is the bond price minus investment value by investment value. What is the percentage of downside risk? Bond price minus investment value by bond price. Okay. What is the conversion price? It is the face value by the number of shares. What is the conversion parity price? It is the bond price divided by number of shares. Okay. What is the income differential? The coupon income minus the dividend income. What is the payback period? The initial extra that we paid, that is the bond price minus the conversion value divided by the favorable income differential. Okay, I may be sounding fast, but then I can't teach this topic again. No? This was a very easy topic. I have taken 3 sums from this topic because I consider the topic to be extremely important. So I have taken 3 sums on it. Okay, I'll just solve one sum. One of the most mechanical and easy topics. So one part of the chapter is conceptual, you know about the duration and the volatility stuff. And the other part of the chapter is mechanical. Okay, that's the OCD part, the money market part, okay, which is not conceptual at all. So we have started with the non-conceptual portion. Okay, look at this sum. Question number 5, features of an OCD. Following is the data related to 9% fully convertible debentures issued by Delta at 1000. Market price is 1000. Now that's a coincidence that the face value and the market price are same. Okay, 9% debenture. Conversion ratio 25. So you will get 25 shares. Usually when we divide the face value by 25, we get the conversion price. And if we divide the market price by the number of shares, we get the conversion parity price. Here both will be same. Straight value. Okay, that is the present value of the coupon and the redemption at the YTM on non-convertible bond in the market is 800. Okay, investment value. Market price of equity share 30. So 25 into 30 is the conversion value, N into S. You are going to get 25 shares, the share price is 30. So 750 is the conversion value. Dividend 1 rupee per share. First question, conversion value, N into S. 25 into 30. Market conversion price. So market conversion price is 1000 by 25. Which 1000? The face value? No. The market price of the bond, 1000 divided by 25. That is 40. 40 is the conversion price. Market conversion price. Conversion premium per share. So how much extra are you paying for the share? You could have bought the share for 30, but you are paying 40 via the bond. So 40 minus 30, 10. What is the ratio of the conversion premium? It's 40 minus 30 by 30. That is 33.33%. Ratio of conversion premium. How much extra are you paying in percentage term? 40 minus 30 by 30. Premium over straight value of the debenture. The price of the bond is 1000. The straight value is 800. So premium over straight value is 1000 minus 800 by 800. 1000 minus 800 by 800, which is 25%. 25%. Favorable income differential per share. So what is the income from the bond? 9% of 1000, that is 90. Okay. And 90 per share is what? 90 by 25 is what? 90 by 25 is 3.6. So 3.6 is what we are getting from the bond. But 1 rupee is what we'll get from the share. So 3.6 minus 1, 2.6 is the favorable income differential per share. What is the premium payback period? So how much extra are we paying initially? 10 rupees, 40 minus 30, 10. And we are getting every year 2.6 extra. So in how many years will we break even? 10 divided by 2.6. 10 divided by 2.6. What is it? 3.85 years. 3.85 years. Okay. So it's a very easy question. People need to be in control of it. You can practice 10 sums of this type. If you feel that you need the CA inter-type, practice. There are around 15-20 sums. Practice them. Okay. I have never felt the need to practice it because it's so logical. Okay, direct. Anyways, so this is OCD. The next stuff that we will come into in bond valuation, the mechanical part, is the callable bond refunding decision. Callable bond refunding decision. Hope you remember, we had issued a bond earlier. And now, interest rates have fallen. It's a callable bond. So we can issue a new bond and retire the old bond, thereby saving interest for the remaining maturity. But in doing so, we have to retire the bond at a premium, so that extra will go. Okay. That premium will be debited in the PL account. We will earn tax shield. If there's an overlapping interest, that's an outflow. Okay. If there's an issue cost on the new bond, then that amount also we get less. So we have to find out basically two things in this type of sum. It's a capital budgeting sum. You issued the bond over here. You are standing over here. Now so many years are left. So here we are taking the decision T equal to 0. You are taking the decision. You have to find out the initial investment over here. And you have to find out the cash flow every year, the savings. This is savings. Initial investment, what do? Payment on old minus receipt of new. So what is the extra you pay today? Plus post-tax overlapping interest on old bond. Overlapping interest on old bond. Because the new bond, you will have to pay the interest. But the old should have stopped. Less tax shield on premium. On premium, you get it right away because you are retiring the old bond. Less tax shield on unamortized discount and flotation cost on old bond. There is no question of saying that, sir, it's bad handwriting. Okay, this is all stuff done in class earlier. So this is the initial investment. Let's focus on the initial investment right now. There are two sums I have taken. Question number 1, question number 11 in the PDF. Question number 11 is the same which I did in class. So I'm doing question number 1. Okay, just 1 second. Question number 1. Tangent Limited is considering calling 3 crores of 30 years 1000 bond issued 5 years ago with a coupon rate of 14%. So 3 crore 1000 bond, 30,000 bonds were there. They were issued 5 years ago and they had 30-year maturity. So 25 years left and 14% is the coupon. The bonds have a call price of 1150. So how much are we paying extra? 150 into 30,000. 150 into 30,000 is 45 lakh. So 45 lakh we are paying extra today. Had initially collected 2.91 crores at that time. So 9 lakh was the discount. The initial flotation cost was 390. So 12 lakh 90. 9 lakh plus 390. 12 lakh 90 was the flotation cost and discount which was being amortized over 30 years. 5 years they are amortized. 25 years amortization is left which will hit the PL account right now. So two things will hit the PL account right now. 45 lakhs and 12 lakh 90,000 into 25 by 30. The company intends to sell 3 crore 12% coupon bond. That's the fact. Instead of 14 we have to pay 12 now. New bond. 25 years bond to raise fund for retiring the old bond. It proposes to sell the new bond at their par value, no discount, but the flotation cost is 4 lakh 25. So today the extra outflow is that 45 lakh we are paying extra and the 4 lakh 25. 49 lakh 25 is the extra outflow today. 49 lakh 25. 1 second. So the extra outflow today is 49 lakh 25,000. 49 lakh 25,000 is the extra outflow today. 45 lakh plus 4 lakh 25. The company is paying 40% tax. Its after tax cost of debt is 8%. That's a discount rate for NPV. If that is not given, we would have used 12% into post tax. 12 into 0.6. That is the post tax coupon on the new bond. But since it's given, we will use 8%. As the new bond must first be sold and then their proceeds to be used to retire the old bond, company expects a 2-month period of overlapping interest during which interest has to be paid on old and new bond both. So let's calculate the overlapping interest on the old bond. 14% of 3 crores into 0.6 into 2 by 12. 14% of 3 crores into 0.6 into 2 by 12. 14% of 3 crores into 0.6 into 2 by 12. This is coming to 4 lakh 20,000. 4 lakh 20,000. Okay, you can check again please. I am checking again. 14% of 300 lakhs. Okay, into 2 by 12 into 0.6. Yeah, it is 4 lakh 20,000. Perfect. Now there are two tax shield we enjoy. Tax shield on the 45 lakh call premium, 45 lakh into 0.4, 45 lakh into 0.4. This is 18 lakhs. Yeah, 18 lakhs. We are enjoying the tax shield and we are also going to enjoy the tax shield on the unamortized discount and flotation cost of the old bond. So if you see again, the discount was 9 lakh, the flotation cost was 390, 9 plus 390 is 1290. So 12 lakh 90 was supposed to be spread over 30 years, 5 years have passed. So 25 years is unamortized. So 12 lakh 90 divided by 30, the whole into 25, the whole into 0.4. 12 lakh 90 divided by 30, the whole into 25, the whole into 0.4. That is 4 lakh 30,000. 4 lakh 30,000. So 4 lakh 30,000 is the tax shield enjoyed today. Don't talk about, sir, what about the new bond flotation cost? Won't that be debited in the PL? Of course, yes. But that would be every year for 25 years, not right now. So, two outflows, two inflows. 49 lakh 25,000 plus 4 lakh 20. 49 lakh 25,000 plus 4 lakh 20,000 minus 18 lakh minus 4 lakh 30. Minus 18 lakh minus 4 lakh 30. What is it? It's 31 lakh 15,000. 31 lakh 15,000 is the initial investment in this bond refunding decision. 31 lakh 15,000. Now the second calculation is the annual savings, for which we do old, new. Old if not called. If it was not called, what would have been the annual outflow for the next 25 years on the old bond? That would stop. So that's the saving. But what is the annual outflow on the new bond? That's the outflow. So old minus new shall be the savings. So firstly the post-tax coupon. So 14% of 300 lakhs into 0.6. 14% of 300 lakhs into 0.6. That is 25 lakh 20,000. 25 lakh 20,000 on the old bond. On the new bond, 12% of 300 lakhs into 0.6. 12% of 300 lakhs into 0.6. And this is 21 lakh 60,000. 21 lakh 60,000. Perfect. Next. Now, the annual tax savings. On the old bond, it is, 9 lakh plus 390. 12 lakh 90,000 divided by 30. 12 lakh 90,000 divided by 30. The whole thing into 0.4. 12 lakh 90,000 divided by 30. The whole into 0.4. This is 17,200. And this is not double counting. Yes, sir, you already took it over there. No. This is the annual tax shield. And over here, it is, what was the flotation cost? 4,25,000. So 4,25,000 divided by 25. 4,25,000 divided by 25, the whole into 0.4. That comes to 6,800. 6,800. Okay, so we deduct it. So 25,20,000 minus 17,200. 25,20,000 minus 17,200 is 25,02,800. 25,02,800. This we start saving. Whereas 21,60,000 minus 6,800. 21,60,000 minus 6,800 is 21,53,200. 21,53,200. This we start paying. So savings is this minus this. Savings is this minus this. 25,02,800 minus 21,53,200. That is 349600. So 349600. 9600. This is the annuity, and this into annuity factor PVAF 8%, 25. I think the annuity factor is given. It is 10.675 last line. So into 10.675. 349,600 into 10.675 is 37 lakh 31,980. 37 lakh what? 37 lakh 31,980. That's the present value of the savings. So NPV is 37 lakh 31,980. Sorry, 37 lakh 31,980 and minus what? 37 lakh 31,980 minus what was the initial investment? Initial was minus 31 lakh 15,000. Minus 31 lakh 15,000. Minus 31 lakh 15,000. Okay, once again, 37 lakh 31,980 minus 31 lakh 15,000, that comes to 6 lakh 16,980. NPV is positive. 6 lakh 16,980 answer. NPV is positive. The bond refunding decision is viable. Okay. If you have taken classes from me in the class notes, it's beautifully dictated. All the steps, step 1 and step 2. 6 lakh 16,980. Okay, let's check their answer. 6 lakh 16,980 NPV. Where is the answer? NPV 6 lakh 69,980. So the final answer is presented right at the top, and then the working notes are there. 6 lakh 69,980 is the answer. Okay, so that is the bond refunding decision. So we keep this class up to this point. We have done 3 types of sums. One sum was on money market. The second money market, we did 2 sums, commercial paper and repo. Commercial paper, I did 1 sum, but I said how to tackle the stamp duty, rating charges and all. Second sum, we did a repo, which was back calculation. I told you to do another sum on repo from the book, security valuation, security analysis chapter. Then we did a sum on OCD. It's very easy from my point of view. It's very mechanical. If you are not confident, please do 10-15 sums on it. And the third sum we did bond refunding, question number 1. Even 11 is on bond refunding. You can try 11 right away and have confidence. So we have done money market, we have done OCD, we have done bond refunding. We are ending the class right now. Thank you.